what's interesting is then, okay, so the debts keep going up. We know the forward look of where the labor force participation rate is going to go, and how it's being funded is liquidity.
Bitcoin Zella stands out with its simplicity and clarity. We've crafted an experience that anyone can dive into, whether you're a crypto expert or just a new to the crypto world. Now guess who keeps his eye on us? The author of best-selling book Rich Dad Poor Dad, Robert Kiyosaki. And we want to take this opportunity and thank all the people who trusted us, and we read every comment. And the best part, it's free. Subscribing now means you will get all new information for free. Don't just follow the trends, stay ahead of them. Subscribe to Bitcoin Zella today and enjoy the new edge. Raoul says Bitcoin is the only asset that beats fiat debasement. He dives into crypto, inflation, and wealth strategies. Let's watch him break it all down.
This is Fed net liquidity. You're probably better to use US total liquidity because that includes the private sector because they're now using the banking sector. So what they're doing basically is debasing currency to pay for the debt. It's as old as the hills. It's as old as the story of economies. It's as old as the story of money. And it's happening at a very pernicious rate of 8%. So you kind of notice it, but don't notice it. But what's happening is asset prices keep going up optically because the currency is getting debased. Even if you look at real estate adjusted by the debasement, by liquidity, it's basically a flat line. But wages are a variable input. And so what you find is that wages do not account for this. It's also the same factor that is driving P ratios that drives everybody nuts. Why are P ratios going up over time? Because the P goes up because of debasement. The E is a variable and doesn't. So it always goes up in line with debasement. And we've shown that over time too. So this is the really big picture of what we look at. It allowed us to understand there's only two assets to own. And then we got to a further realization, which is, okay, if 97% of all of NASDAQ's price action is driven by debasement. It's the strongest factor we've ever had in any macro regime in history. Okay, great. That makes macro super easy. For crypto, it's 90%. So we've basically got a factor that's so powerful that nothing else matters. Brilliant. So then let's take the NASDAQ. If we've got one force, one economic force, we take the NASDAQ, we divide it by by Bitcoin, it's down 99.97%. So you kind of get one asset allocation only, which is crypto, which is bizarre. In a macro world, we now think you need concentrated portfolios as opposed to diverse portfolios. In fact, diversification just destroys returns now because you've got one clear macro factor. So that's really what we're doing. And then we spend a huge amount of time working on the business cycle and the various components of all of this, how it comes together and where we are in timing of that.
Legendary trader Peter Brandt is still long on Bitcoin, but he's sounding a cautious note. After Bitcoin hit a new all-time high of $112,040 on Bitstamp, Brandt highlighted a crucial level traders need to watch: $107,000. If Bitcoin holds above this level, bulls are still in control. But if it breaks down, things could get shaky fast. Brandt's latest analysis focuses on an expanding triangle pattern, also called a broadening wedge. It's a technical formation where the highs and lows keep getting wider, hinting at growing market volatility. Bitcoin recently broke out above the top line of this wedge, which is a promising sign. But Brandt warns that this pattern has a history of false breakouts, so traders shouldn't celebrate just yet. What makes this level so important? There's a horizontal support line around $108,100, which acted as resistance during Bitcoin's months of consolidation. Now that it's flipped into support, it could be a key foundation for the next leg up. Brandt has set bullish targets of $120,958 and $134,886 if the breakout holds. Still, if Bitcoin dips below $107,000, the current pattern could be invalidated, potentially leading to a deeper correction. With Bitcoin now trading near $111,000, the next few days could be critical for the entire crypto market.
I think at worst, it's the latter. At best, we saw this happen in the 1950s and 60s. I alluded to that before. Like World War II, the US economy was over 100% of debt GDP. Most economies were. What did they do? Financial repression. They shortened the debt. They rolled it every 4 or 5 years. They used yield curve control to financially repress, which is essentially currency debasement, because they, at the time the dollar was pegged to gold. So it's the only way of doing it that way. And then what they did was wait for population growth. They had a baby boom, the largest in history, and productivity growth from technology. And what happened was GDP grew faster than debt, and over time, debt to GDP fell to a manageable level until the inflation of the 70s, driven by demographics, kicked in as everybody started getting into their 20s. And so we've seen that before. So this way around, our thought process, when we first said it, people thought we're insane, but I think it's becoming pretty obvious that AI and robots are replacement humans. And we're going to have infinite at some point. So the idea is, where does we have infinite? Because that breaks the whole GDP magic formula, right? Nothing makes sense anymore. We call that point the economic singularity. And we kind of finger in the air said, probably by about 2030, because everything's going exponential in terms of speed of AI and robots, we probably have no idea what an economy looks like anymore, or what it means. Everything we all look at is going to fall apart. So we kind of think we've got 5 years, so this cycle and the next cycle. And part of something Julie and I talk about between us too is like this cycle, people are starting to get it. I think once we get through a pause that refreshes, a contraction in liquidity, the cycle, I think the next cycle, everybody's going to go all in and realize it's the kind of end of times, because we just don't know what's beyond that. Nobody does. And anybody who says they do is lying, because we have literally no idea. When you've got free intelligence, infinite intelligence, and we don't know. And we don't know, what the energy constraints are going to be, or whether there are any, or whether we solve them. We just don't know. So I'd rather be honest with ourselves and say, right, okay, we got 5 years. That's it.
Bitcoin could be heading toward $133,000 by September, and many traders might be caught off guard. According to 10x Research's Marcus Thielen, a lot of market participants seem underexposed to Bitcoin, especially after last month's option expiry wiped out significant positions. As bullish momentum builds, traders are now mostly buying call options, betting on even higher prices. That's a clear sign they're scrambling to catch up. Thielen says their trend model flipped bullish on June 29, right before Bitcoin broke to a new all-time high of $112,000. The model now gives a 60% chance of more upside in the next 2 months. Historically, similar setups have led to gains of about 20%, which would push Bitcoin close to $133,000. With spot Bitcoin ETFs seeing over $215 million in inflows in a single day and optimism around U.S. crypto policy, the stars seem to be aligning. Thielen believes the market is shifting into a higher trading range, and upcoming events like the July 15 CPI release could be the next big push. Even though Q3 is usually slow for Bitcoin, analysts like Gel and Rect Capital think this time could be different. Sitting out now, warns Matthew Hyland, could be a painful mistake like missing the rally of 2020 all over again. If you've been with us so far, a big thank you. Don't forget to subscribe for free to Bitcoin Zella for your daily news. The link is waiting below. That's all for today's crypto news. Stick around for more updates, insights, and analysis on cryptocurrencies. Share your thoughts in the comments, like this video, and subscribe for more exciting content.